We're going to start the week off by looking at a handful of charts, and then we're going to go through the key events that will be occurring throughout this week. And there's a couple of them that we need to pay attention to. So nothing specifically to do with anything actionable today, but that will likely come throughout the week. It's always good to be prepared. And the trading takeout today is going to be, do you actually need fundamentals if you're a technical trader? Is everything already in the chart? Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. First up, let's have a look at the S&P 500 E-mini. This is the futures contract. It's pretty much exactly the same as the CFD that you would get via AXI. And I just wanted to also add on the linear regression that I was referring to, I think, just last week even. I'll change this to 2 standard deviations on the upside and then 2 here as well. And you can see here that we've got a really lovely sort of channel here. The market is behaving within 2 standard deviations of this mean. So from high to high, this is effectively where we're looking at. If we were to draw it from high to key low as well, you could see that it's a completely different channel. So we have broken out of this sort of trend here, if you like. And I would argue that where we're looking now would be to trade. Let me just get rid of this one. Okay. Would be to trade up to around this level, retest prices up here and see what buyers are feeling there. You can see here that we're above the 200 daily moving average as well. Before I get into anything further, what I added, in case you missed what this was a linear regression. So this is basically a line of best fit, this red line, of all the data between here, there to here, okay? And then there's a 2 standard deviation applied above and a 2 standard deviation applied below. What this then means is that you can see that this is an objective trend line rather than just, I guess a subjective trend line like I've drawn up here. But you can see that they rest pretty much the same. So this is why I'm saying, okay, this is quite a key resistance level up here. However, the way that I would look at this market going forward is we trade very, very similar to something like this. Okay, I think the fact that we are coming to the end of the US rate hike cycle is suggesting that data is going to deteriorate, but deteriorate in a way that doesn't implicitly mean that we are going to get rate cuts right away. It means that we'll start to get gradual rate cuts. Now, I don't think the market likes that, because what that means is an earnings deterioration in expectations, which is fine, but it depends on how long that deterioration goes for. An earnings deterioration also means that jobs will start to get cut. We saw jobs get cut in the tech sector at the start of this year. But when they actually start to get cut in the real economy is when we worry. I don't really consider tech as the real economy because of the bloat in hiring that they had over the last 3 or 4 years. So they just hired a ton of people through 2020 to 2022. And now it's likely that a lot of those got cut at the start of this year. But when we start to see manufacturing jobs get cut, when we start to see a lot of service jobs get cut, that is when we should start to worry. This is one of the kind of backings that I have behind this idea with regards to rate cuts and rate hikes and the rate path cycle, basically, let's say. So that's pretty much where I'll be looking at with that on the ES. And there's probably something that you could add in with some fibs here. Oh, not that one, that's not a fib. This one. I don't really use fibs that often, but I guess you can use it as a retracement kind of tool. You can see here that this high was pretty much bang on the 78.6% fib. You might come back and retest that, or you could always extend up here back to where we started, but I really, really doubt it. And I guess if we then extend from the recent one down to here, you could start saying that we come back to this fib, but that gets into astrology. That's why I really, really don't like technicals in that perspective. They're very, very subjective. Fibonacci levels like that, they're not me. I prefer to see, okay, well, here's an objective place where sellers have come in before. If there's a trend following down that way, like here, for example, it increases the likelihood slightly of the same occurring again. With a 200 moving average, lots of commodity trading advisors, so trend followers, also follow moving averages in that way. At the end of the day, the trend comes really from the fundamental side, which is what I'm going to go into on today's Trading Takeout. So that's where I'm looking on the ES. Now, let's move over to the Euro, and there's very similar, very kind of similar things going on with the Euro here. I'll get into those. And the way that I'm looking at the Euro is, again, 200 daily moving average. It's my favorite thing to decide if we're in a sort of good period or not, or if the market's behaving good or not. You can see here that we've started to use this sort of big level here as support. Personally, I think this is kind of your flip zone. I think that if we trade below this level, which is, let's call it 1.05, 1.065. If we trade below there, then that's when we start to really see lower prices and we start to kick these levels in here. So when we start to see, 1.046, and I've been saying that I think the Euro is extending down there. Probably what happens before is we trade up something like that and then head here. The reason for this is if we look at German bond yields, the German Bund is going to have to start getting repriced pretty quickly, in my view. You can already see this sort of turning over here. We've had this big spike up where it's sold off even more, up into 3%. But I think now it accelerates the spread between the German bond yields and US bond yields. So US bond yields are going to remain a bit higher for longer, while the Eurozone yields actually collapse. And what that means for FX is that the interest rate differentials change. So you're getting less return for your euros, basically, in the Eurozone, if you want to think of it that way, than you are versus the dollar. So what's the incentive? It's always what we have to think about. The incentive is to stay long the dollar, sell the euro, okay? And so that's what I think happens. We start to see this turnover through here very, very soon. This should, and if we correlate, let's throw the euro over this as well. So if you find Euro USD, we use ICE1. They basically work on an inverse relationship here. Okay, so what you're going to be looking for really is, and it's better to use the spread. Let me just include the spread, in fact. Okay, that's right. You want to be looking at the spread. So really, if the spread is decreasing over time, then the yield differential will change, and that will lead to a decrease in the price of the euro. This isn't actually showing it very well for some reason, but that is what it represents effectively. And I think going forward, the Eurozone, the structure of the Eurozone is suggesting that euro needs to be lower too. So from a technical analysis perspective, you've got the backing of that 200 daily moving average here, capping any upside. I think the dollar through year end also becomes much more stronger in the global context. I think that we start to see some liquidity issues in the dollar. And that will imply usage of maybe FX swap lines, FEMA, eventually, if a crisis does start to kick off with dollar liquidity. But I think it's always good to look at those two assets, the ES and euro dollar, from that perspective first off, because then that can dictate the rest of the week. Euro dollar, most liquid currency pair, and the ES is, I think, the most liquid future outside of some short-term interest rate contracts. And, they're the most sensitive to interest rate changes too. So have a focus on them, extrapolate out into, the other currency pairs that you like to trade. If it's Aussie dollar, that means, it's very correlated to risk sentiment. If it's, CAD yen, again, exactly the same. Any cable pairs, any sterling pairs, again, exactly the same, very correlated to risk. So try to develop out your own way of feeling how risk sentiment is developing at the start of the week. So, key event this week is in front of us, the US core CPI, US CPI generally. This should really dictate exactly what is going to go on with US rate hikes going forward. I think it's going to put a cap in them. I think it's going to suggest if we get a miss, so if it's lower than expected, it definitely caps, the potential for what the Fed can do. Currently, Barclays is thinking that they raised 25 basis points in January after switching it from December, which is, it's a minor move, but it's showing the direction perhaps. Other central banks, other investment banks are thinking similar. I'm just going to have a very, very brief look at what the actual market is saying, because interestingly, last week, the UK started to price in some cuts for 2024, which is, quite an interesting development at this stage. Funnily enough, I always find that the Bank of England does things before the Fed. Like, for example, last year, we saw the issue with pensions crop up with LDIs, right, back in September over the Trust's quarantine budget. And what did we see them do? We saw them introduce a liquidity facility to facilitate basically the transition of bonds maturing and bonds that had to be rolled over, and basically recomposing portfolios of pension funds. Now, one thing that the Fed did then in March or April, when the Silicon Valley Bank was collapsing, when Credit Suisse was collapsing, is they introduced the Bank Term Funding Program, which is basically the same thing, just for banks, providing liquidity again. It's not QE, but it kind of is QE at the end of the day, if you want to think of it very, very simplistically. Now, the Bank of England pricing in cuts is very interesting, because we're now looking at quite a substantial rate of change, let's say, in interest rate pricing going out all the way to ZQV4, which is the end of next year, I believe. 2025, might be March 2025. I can't recall what the codes are right now. But it's an interesting development in terms of, we've maintained, this was what the curve was in red in August, we've maintained sort of that cut stance. If we get a weak CPI tomorrow, I think that just puts the nail in the coffin for any further rate hikes whatsoever. The market is primed now for this curve to sort of come off. And so I think what's absolutely key here is how, and this is where we get into whether it will be a soft landing or hard landing. What's key now is how the data responds. If the data deteriorates rapidly from here, we'll see that repricing happen very, very quickly. If it's less so, we won't see it as fast. And the job of the trader now, job of you guys, is to understand and deduce to what extent that is going to affect risk sentiment. How will the change in interest rate pricing affect risk sentiment? How will the change in data affect risk sentiment? I guess that's what my job is here for as well, to try and guide you as best possible every day. And it's a hard job. It is a very hard job. So in my view right now, we're poised for tomorrow. I think it will come in a little bit softer. If it doesn't, it will be a big surprise and volatility will pick up. It will definitely pick up. And I think we would see lower on equities. However, there's a lot of momentum in the market. There's a lot of people still wanting to buy. The equity positioning isn't that stretched. It's not that long. People are still a tiny bit fearful. If we look at the VIX as well, let me just jump onto the VIX for 1 second. If we look at the VIX, it was ever so slightly elevated last week. Actually, sorry, no, that's completely wrong. It actually closed lower last week. Opened up a little bit higher this week, but I think that's to do with rollover more than anything. If we start to see any kind of event volatility jump in here, then that will be a change in the VIX and people might start getting a little bit scared. But generally, we've got to wait for tomorrow. it's nothing really to concern ourselves with at the front part of this week, in my view. So the age-old argument of, oh yeah, I'm a technical trader, I don't need fundamentals, etc., popped up again the other day on Twitter. And, my stance is very varied on this. I think that you can be a technical trader predominantly, but you can never, ever disregard the fundamentals. At the end of the day, without the fundamentals, you wouldn't even have the ability to be a technical trader. The markets wouldn't exist. There would be no point of the market. And an example that I gave was, okay, let's look at Bitcoin. Bitcoin doesn't necessarily, on the face of it, have any value. But if you go to the very beginning as to why Bitcoin was created, it was created in response to money printing, in response to zero interest rate policy, Fed oversight, 2008 anti-establishment type thing. So if the origins of Bitcoin are based in money printing and anti-money printing, then surely that gives you the fundamental backdrop for crypto right there. If money printing's occurring, if interest rates are lower, then Bitcoin's going to go up because that's why it was created. So although everyone in crypto is predominantly technicals focused, at the end of the day, by ignoring the fundamentals, you're ignoring the origin of Bitcoin. And this isn't necessarily about crypto, but it's just a perfect example because so many in crypto are technically focused. It's the same with stocks, At the end of the day, what you're doing in technicals is you're piggybacking off of other people. You're piggybacking off of other trades, momentum, things like that. But where is that momentum created from? That momentum is created from people who believe in the company's fundamentals. So you basically have to always think that what you're doing with technicals is piggybacking. Okay? Once you start considering piggybacking, you might then be able to be more comfortable with the realization that there are people who have intentions of buying a stock or selling a stock or shorting a stock or in whichever asset you're talking about of doing these things because of some intrinsic belief, value or fundamental backing. So that's why it's important for me to always consider that fundamentals are the bedrock of any market, of any asset class.